plan is pretty straightforward. We have a three-step plan. We're going to drive operating margins to double digits. We're going to drive balanced revenue growth, and we're going to improve our asset intensity and an ROIC of 200 basis points. Overall, drive a total shareholder return of 18 to 22%. It's a 50th year of FedEx. We built this asset base quite strongly, and now it's time to unlock the value of this.
Your next quarter, in what I thought you were going to make versus what you're making, it says to me, don't buy back shares. Don't buy back shares.
Yeah, we're reviewing all our cost actions right now. We're reducing our capex quite significantly this year, and we think it's allocation of capital. This is a good use of our capital.
But 548 was the estimate for second. You're going to come in at 275?
Well,
that's got to be more than just Asia service.
No, we're seeing that the volume decline in every segment around the world, and so we started our second quarter. The weekly numbers are not looking so good. So we just assume at this point that the economic conditions are not going to be good. But it basically allows us then to fully go into cost management mode and take those actions that we can then restructure FedEx in a different way.
Raj, are we going to a worldwide recession?
Well, I'm not an economist, but you know
more than economists. Come on, they don't. They just push papers. You actually look at papers.
Well, I think so.
You think we are going to a recession?
I think so, but again, these.
You could do so. You want.
All right. Today is Wednesday, October 12th, and this is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. Happy CPI Eve. Although, once you get this video, it's probably CPI Day. So I'm gonna try to be as brief as I can in this preview of the CPI, because unlike September, when the market was jubilous and rallying ahead of the CPI report, assuming it's going to confirm the pre-assumption by the market that inflation is indeed going down. And hence, the element of surprise was to the downside, that if the CPI comes out hot and it negates the market's pre-assumption, down we go. And this is exactly what we got last month. This time around, things are quite different because the market has been actually acting negative ahead of the CPI report. Meaning, this time around, the element of surprise is to the upside. Meaning, if the government cooks give us a tame reading month over month when it comes to inflation, the likelihood is the market goes higher. And since the market has been refusing to rally ahead of the CPI, there is also a possibility that even if inflation comes out up month over month by a little bit, that we could see a relief rally. We know that's not going to last because the market has many other problems to face besides the CPI. However, if the CPI reading comes out too hot, showing a significant increase month over month when it comes to inflation, then JP Morgan says, not me, JP Morgan says, if we have a too hot reading of the CPI, stocks can go down 5% right away. Now, what evidence do we have as leading indicators to this reading of the CPI? Well, we have some bullish, and some bearish. Here's the bullish one. This is Adobe's Digital Price Index, the DPI, which we used last time around to predict the month-over-month increase in the CPI and the market's surprise to the downside. This time around, the DPI says inflation went down by 0.2% in the month of September. So this is the good news for the doves / the bulls. But here's the problem, and perhaps the most alarming part of this inflation. Food inflation, grocery store inflation, continues to move higher and higher and higher, even according to the Adobe DPI. In September, grocery inflation went higher by 14.3% year over year. This is up not just year over year, but also month over month. Now, we know that there is a problem with core CPI, meaning excluding food and energy. Core CPI continues to move higher. Now, what do you think will happen if, let's say, food inflation continues to move higher month over month as the DPI suggests? So it's not just core CPI moving higher, it's also food inflation moving higher. And if you thought this was bad, how about we add some energy inflation too on top of that? That went higher month over month in September. What is the leading indicator that we have for that? The answer is, how about gasoline prices here in the state of California, the largest state in the nation? A month ago, the average price was $5.4 a gallon. Now we're talking about $6.2 a gallon here in the state of California. So this is about $1 worth of increase at the pump month over month. And I know that this includes October when we're talking about September here, but the last 20 days of September, this reading suggests that we have seen an increase in the average price at the pump, at least in the state of California, which once again happens to be the largest state in the nation. On top of that, we got more bad news in the morning today. The PPI, the Wholesale Price Index, actually went higher by 0.4% in September. So heading into the CPI, the question is, do we have some good news that maybe inflation went down month over month? Because this is what we're looking at right now. We don't care about year over year. We care about month over month, because if inflation continues to go down month over month, that will get us closer to the Fed pivot or the Fed pause and hold or whatever it is. But if inflation continues to move higher month over month, we got a problem. The Fed has to be even more aggressive. So yes, we got some evidence that maybe inflation went down month over month in September, and this evidence is the DPI. However, the overwhelming evidence says that inflation went higher month over month in September. The question becomes, how high? Is it by 0.1%? If that is the case, maybe the market can catch a relief rally because it headed into the CPI reading beaten and bruised, and expectations were absolutely abysmal. But if the reading goes higher month over month by 0.5%, 0.6%, or better yet, let's say a full percentage point, you will see what JP Morgan talked about, the 5% tumble happening. So this is what I'll be watching for. But until we get the CPI, in tonight's program, I want to talk about 5 different companies from different sectors of the economy, different financials, different macroeconomic situation, and I want to see what the troubles in these companies are and where the overlap is. Because once we identify that, we can identify a theme that is going on in corporate America. And since I already know the answer because I've been preparing for this video, and spoiler alert, yeah, things are not going good and they're getting worse by the day. What are you talking about, Maverick? Well, here it is. In focus tonight. Corporate America sounds the alarm. It is not just one company, not one sector, not one macroeconomic situation. It is all of them now. If it walks like a duck, if it sounds like a duck, you know the story. In this program, I'm going to talk about 5 different companies. That is FedEx, Amazon, Nike, Carnival Cruises, and JP Morgan. By the end of this discussion, you're going to find out a theme from all these 5 companies. We'll get there in a minute, but let's start by this. The headline reads, FedEx, UPS, U.S. slowdown, global growth. You might have heard about it already. We have troubles in FedEx and UPS. But my question to you right now is, are you paying attention or not? Or are you just playing me in the background while you're busy with the nasty incognito tab? Because I don't know if you noticed the date on this article or not. The date is May 1st, 2008. Back then, the shipping giants were eyeing a global slowdown. And I wonder what happened a year later. From that point on. Here's another one. And the date is July 15, 2008. It says CSX Q1 profits down 30% as freight volume drops. And we all know what happened a year later. The recession hit, and it was the most severe recession since the Great Depression. In other words, when you have these transportation companies warning about a global slowdown, this happens to be a leading indicator that indeed the economy will dip into a recession. And guess what's happening right now, here in 2022? Well, we know recently, in the last month, FedEx shares crashed by more than 20% in a single day. Why did that happen? Well, here it is. And listen to this. FedEx shares fell more than 20% after the company reported a swift downturn in shipping volumes in recent weeks as macroeconomic trends worsened. Prompting a round of belt tightening to preserve profits. And why is this profit warning such a bad news for the U.S. economy? It is a leading indicator. There is something called the Dow theory. When the transportation stocks, transportation companies start to suffer and they see a massive slowdown, this is the leading indicator that a recession is about to hit. Remember, these companies were the leading indicator that the economy is going to recover from the crash of the thing back in 2020, we started to see and hear from these companies that the shipping volumes are increasing dramatically. And this is how we knew that by spreading trillions of dollars worth of stimmies in the economy and folks staying at home, they're going to start ordering stuff and shopping online. And you're going to see that volume surging higher by looking at FedEx, UPS, all of these shipping companies. Even the railroad companies. Now we're seeing the opposite. Now we're seeing the volume slowing down significantly. As the consumer gets hit with inflation, they cannot really spend on buying goods anymore. They're paying more at the pump, they're paying more at the grocery store, they're paying more for utility bills, and soon enough, they're going to pay more for interest rate charges on credit cards and all of these loans they've been taking, and they're not going to have the disposable income to stimulate the economy. And we're seeing this from this profit warning by FedEx. And it's not only that. You've heard the CEO in the intro of the video. He says a worldwide recession. It's not only a slowdown in the US, it's a slowdown in China, in Europe, Middle East, everywhere we're seeing a slowdown. So we know ahead of time that we're going to have a worldwide recession in 2023. And it's not just a small warning that, hey, folks, we're seeing some slowdown in the volume of shipping, yada, yada, yada. It is a massive miss. This miss is the worst in 20 years, according to Deutsche Bank. And it's no wonder why FedEx stock crashed by 20% in a single day. So the severity of the warning is really important because it will lead us to the severity of the recession. FedEx pre-announced last night, this was back in September, the weakest set of results we've seen relative to expectations in our 20 years of analyzing companies. This is once again according to Deutsche Bank. The package delivery giant said in a statement Thursday night that it expects first quarter earnings, excluding some items, to be $3.44 per share, or roughly 33% below the average analyst estimate of $5.10 per share. In addition, FedEx withdrew its earnings forecast for 2023, saying macroeconomic trends have significantly worsened, both internationally and in the US. And this is the most important part, and are likely to deteriorate further, fueling fears of a broad-based earnings decline. Hello, earnings season, right? The FedEx warning came as a slap. It is a solid sign that the economy started slowing, said Ipik Ozdakarara, a senior analyst at Swissquote. This is certainly the first in a series of warnings that we may see for the quarters to come. FedEx is not the only company making a warning that the macroeconomic backdrop is likely to impact the bottom line. GE finance chief said on Thursday that supply chain challenges are weighing on its third quarter performance, while some of Wall Street's biggest banks expect deep declines in investment banking fees for the current quarter, with investors still spooked by inflation, rate hikes, and a possible recession. We'll talk about JP Morgan in a second, but here's the problem with FedEx. Revenues are moving higher. The company is benefiting from the rise in inflation. Folks are responding positively to the increase in prices by FedEx, and they're paying more. The problem is, expenses in this stage of inflation, expenses are rising at a faster pace than the rise in growth in revenues. And therefore, we see the operating profit for the company actually trending down, even though revenues are moving higher. And what is the remedy for all of that? Well, you got to cut expenses. And here it is. FedEx is planning up to $2.7 billion in cost cuts. And most importantly, will raise shipping rates. Folks, to me, this is a company that is gasping for air. It's a company that says, we're going to continue to raise rates because we have to battle inflation, including wage inflation, including fuel inflation, including whatever inflation. All of these input costs are rising higher. And yes, the drawback could be a drop in demand, but we got to take this risk. And look, at some stage, let's say back in 2021, it was possible for companies to battle inflation by just raising rates, raising prices, or shrinkflation, and that did the job. Margins were pretty good. But now we are in a different stage of this inflation, where raising prices is not good enough. You got a company raising prices by cutting costs. Now, we're going to revisit this by the end of the segment, but I want you to think about it. Put yourself in the shoes of the CEO of FedEx, for example. What is the easiest way for you to cut costs right now? What do you do? Think about it.
Think about what you'd think about.
In the meantime, I'm moving to Amazon because a lot of folks say, hey, the weakness in FedEx is actually due to Amazon stealing their lunch. Is it really? Because we have trouble in Amazon land too. What is the problem with Amazon? Here it is, the headline from the New York Times. Amazon posts 7.2% increase in revenue, and this is the slowest growth rate in 2 decades. Growth has slowed from its pandemic highs as people return to shopping in person and pull back on spending in an uncertain economy. Okay, and what is the problem with all of that? Revenues are down, things are slowing down. What else? Here it is. The headline from Reuters reads, Amazon raises hourly pay for warehouse and transportation workers. So even though we're seeing an environment of a slowdown in the growth of revenue, a slowdown in spending, this is still being combined with a shortage in labor, and therefore wage inflation continues to move higher. Here we have yet another company with a slowdown in revenue, yet expenses continue to move higher, and the margins continue to get crushed. Are you noticing a theme now? FedEx, Amazon, and here we have another one. What about Nike? Nike's stock also crashed recently, and the reason they gave us is they have excess inventory. They're overstocked, and they have to get rid of this excess inventory by steep discounts. In other words, when they made this inventory, they paid for inflationary input prices, be it the leather, the sole, whatever is used in making the shoes. By the time they got the shoes, consumers have shifted their spending priorities. Why? Because inflation went significantly higher, and now the consumer is spending more at the gas pump, the grocery store. You know the deal. They're not spending and buying shoes. So whatever Nike wanted to charge initially for these shoes when they were being made, they're not going to be able to charge that anymore. They have to move the prices down until the aggregate demand kicks in and the consumer says, okay, this is a really good deal. I gotta buy the shoe. What does that do for the company? They're gonna lose money on this excess inventory because they paid a top dollar to make this inventory. Now they cannot charge top dollar to sell this inventory. They might have to sell it at a loss. And therefore, Nike stock crashed by over 14% in a single day after the athletic wear maker posts a 44% jump in quarterly inventory on supply chain issues and warns, most importantly, when a margin squeeze. And again, notice the parallel here. The miss by FedEx is the worst in 20 years. And Nike's inventory glut sent the stock down by the most in 20 years. We effectively have a few seasons landing in the marketplace at the same time, said Matthew Friend, and this is Nike's CFO. He also added, because we have a portion of that inventory being seasonally out of relevance, we have decided to take that inventory and more aggressively liquidate it so we can put the newest and best inventory in the front of the consumer in the right locations. So that's where we're focused. In other words, yeah, we'll eat the loss on this excess inventory, but we have no other choice because this inventory happens to be seasonal. And if we don't get rid of it right now at whatever price, it goes out of relevance. Nike said gross margin fell by 44.3%. In the quarter ended August 31st, in part by high freight and logistic costs and U.S. dollar strength. This is an important point, the strength of the U.S. dollar. The company also sees the U.S. dollar pressuring full-year revenue by $4 billion. Wow. And expects gross margins to decline by 200 to 250 basis points compared with the prior year. Look at this. This is absolutely abysmal. The last report we got from Nike, revenues were up by 4%, but the cost of that revenue went higher by 8%. Double the rate of growth in revenues. Likewise, the rate of growth in expenses went higher by 10%. So you have a company with the rate of growth in revenues of about 4%, but this is being overshadowed by the cost of sales at 8% and the cost of expenses at 10%. It's no wonder why the company's net income, bottom line, is down by 22% year over year. And it gets even worse. Notice the impact of the strength in the dollar. North America sales went higher by 13% year over year. No problems here. But in Europe, Middle East, and Africa, sales went higher by 17%. But because of the strength of the dollar, sales went higher by only 1%. The dollar shaved off 16% in the rate of growth in revenues in this particular region. Unbelievable. And on top of that, there's a massive problem for Nike, which is the weakness in the Chinese consumer. Be it because we have the lockdowns or be it because the Chinese consumer is increasingly becoming anti-American and they're not buying Nike shoes anymore. Whatever the reason is, Nike's sales in China went down by 13% year over year. But once again, the strength of the dollar magnified the drop from 13% to 16%. On top of that, in the Asia Pacific and Latin America, Nike sales went higher by 16% year over year. So that's good. That's not bad at all. But when you factor in the strength of the dollar, it shaves off the rate of growth from 16% all the way down to 5% year over year. This is a major problem, not just for Nike. Any company that does business overseas is suffering from the strength of the dollar. And folks, once again, this channel predicted all of this, the challenges that Nike's about to face, the weakness in the Chinese consumer, and I made a video about it about 9 months ago, saying something strange is happening in China. And I spotted the beginning of the Chinese consumer shunning Nike. And now we're seeing all of this prediction being materialized. On top of that, about a month ago, in the members-only videos, I talked about the Chinese threat for certain American stocks. We talked about Nike, and this is exactly what I said. Take a listen. Now, what do we see in this name? After this massive underperformance and collapse since the top, we have an important support at around 104.5. Now, it's not a surprise to you that the bulls would argue, just like many other charts right now, what if this is a bottoming formation of a reverse head and shoulder? Okay, we'll play with that. No problems here. But once that support is broken, the reverse head and shoulder goes out of the window, we will see a massive flush down in this name. We haven't seen the end of the pain yet. We'll look at the monthly chart for NKE. Again, we're seeing acceleration of the negative momentum on the MACD indicator. We're seeing a negative divergence in the RSI. The monthly candle so far doesn't look good. Once that important support is broken, say goodbye. We have another massive leg to the downside. Some would say that leg would be the epic finale, as Jeremy Grantham was talking about. So this is a critical support for the bulls to keep. Once it's broken, when we see weekly closing below that number, we will see another flush down coming. And here's the update. Since the chart broke the most important support of 104.5, the stock went down by over 21%. So again, there is a benefit of being a paid member in the Maverick of Wall Street channel. I'm just saying here. Maybe I'm biased, I don't know. And speaking of being biased, here it is. The analysts say that it will be a difficult Christmas season for Nike. But there is hope. There's always hope. We can just cross our fingers and hope. Hold hands together and hope that the recession is not going to happen. It's going to fix itself and everybody's going to live happily ever after. Cut the credits. But the problem is it's not just FedEx or Amazon or Nike. It's more than that. How about Carnival Cruises? Let's talk about that one. What's the problem with Carnival? Recently, the stock went down by over 20% and they attribute that to ballooning costs. What are they talking about? How about this? You know that I love the operating margin. Now, when we look at the operating margin for Carnival Cruises, it is negative 328.14 in 2021. Okay, we can say there was a lockdown back then. People could not cruise. Of course, the ratios are going to be abysmal. But even now, with the reopening and the surge in cruising and traveling and all of that, the operating margin is down by negative 6.5%. What does that mean in English, Maverick? What does that mean? It means that for every dollar the company generates in revenue, it is losing $6.50. Why? Because they're paying a lot in expenses. We talked recently in the aftermath of the employment report about the wage inflation phenomenon in the leisure and hospitality sector of the economy. Leading wage inflation in the economy is leisure and hospitality, including cruises. They're paying an arm and a leg to find employees, an arm and a leg for fuel costs, but they do have limitations on how much they can increase ticket prices without alienating customers. But there is another problem with Carnival Cruises. You see, the Fed is raising interest rates dramatically in a rapid pace because they have no other choice. They've been saying that inflation is transitory, and now they're playing catch up with inflation and they have to raise rates dramatically and in a rapid fashion, and they're doing exactly that. Now, the risk with raising interest rates dramatically in a short amount of time is we have in the economy all of these zombie companies that are drowned in debt, and as interest rates continue to move higher, their expenses in paying these interest rates also continue to move higher. So if you thought that Carnival Cruises had a problem with wages or input costs, there is another shoe that is dropping right now. And this shoe is the debt for Carnival Cruises, which is absolutely insane. When we look at the solvency ratios, for example, be it the debt to assets ratio, which is how much debt and liability the company has as a portion of their assets values. The answer here in Carnival Cruises, 68%. And it gets even worse when we talk about the debt to equity ratio, which is at a stunning 4.21, meaning the debt is 421 times the value of the equity of the company. In other words, this is a company drowning in debt, and as the interest rate continues to move higher, well, they're going to have to pay more and more and more. And at some point, they cannot do it anymore. They're not generating enough revenues to pay their employees all of these inflationary wages. They don't have enough revenue to pay the interest rate expense. And on top of that, the revenue is going to slow down as the economy heads into a recession. Do we have to spell it out for you folks? Put two and two together and find the answer for yourself. And lastly, what about JP Morgan? What is the problem with JP Morgan? Well, we heard Mr. Hurricane, Jamie Dimon, who said that the U.S. is likely to tip into a recession in 6 to 9 months. And now we have banks, not just JP Morgan, building a $5 billion cushion as the risk for a recession continues to grow. But we have a problem that is particular to JP Morgan, and it is a stunning warning. JP Morgan warns of up to 50% drop in investment banking fees. Wow. JP Morgan Chase, aka the Landromat, third quarter investment banking revenues could be as much as 50% lower than last year. And this is according to one of the bank's most senior executives, Daniel Pinto from JP Morgan. He is the president and head of corporate and investment bank. He said he expected third quarter investment banking fees to be down 45 to 50% on the $3.3 billion achieved a year earlier. And this is on the heels of investment banking revenues being down 44% in the first half of the year. And we know that JP Morgan is announcing earnings on October 14th. The gloomy forecast for the largest U.S. bank by assets, which is an industry bellwether, underscores the anxiety in Wall Street over deal-making slowdown amid economic uncertainty, the war in Ukraine, an unsupportive debt market for leveraged buyouts. And it's going to get worse for JP Morgan. You know why? Mr. Hurricane, the boss of JP Morgan, says that the next drop in the stock market will be another 20%. And he says another easy 20%. But he warns that this upcoming 20% drop will be much more painful than the first, because this is the 20% in which we're going to see things blowing up. So in summary, ladies and gentlemen, what do we see here after looking at 5 different companies in the economy? Let's start by FedEx. What is the problem in FedEx? Well, we have a slowdown in revenues, yet the input cost remains high. In other words, the margins are getting squeezed in FedEx. What is the solution to all of that? Number 1, layoffs. Number 2, charging more. And they are doing exactly that. But pay attention here. The solution entails raising prices and laying off employees. What does that say? Prices going higher, yet the pace of economic activity and job creation, job preservation, that goes down. Hence, stagflation. Now, what about Amazon? What do we see in Amazon? The same exact problem. Revenues are slowing down, yet they have to pay higher wages in the warehouses, for truck drivers, for logistics. And the solution here is, if you have a slowdown in revenues and you're paying higher wages for your employees, is number 1, get rid of some of these employees, and number 2, raise prices. Once again, a stagflationary effect. What is the problem with Nike? Number 1, we have excess inventory. Number 2, we have a slowdown in China. Number 3, the dollar is wreaking havoc in Nike's earnings. What is the solution? The answer is Nike's hands are tied. There is little they can do here. And that means steep discounts. They have to mark down all of this excess inventory, and they have to lay off employees in response to the massive slowdown in China. Now, what about Carnival? The problem with Carnival Cruises is they have rising input costs and they have limitations on how much they can raise their ticket prices. On top of that, they have a massive problem with high debt. What is the solution here? So that's not going to work out, at least not right now, until the demand slows down because we have a recession. They can raise more cash by issuing more shares and more equity, which means if you're buying the dip in Carnival, you're begging to get slaughtered. The company needs to raise cash, and they will raise cash at every single opportunity. Every time the stock moves higher, it presents an opportunity for management to raise cash. In other words, stay away from these kind of stocks. You're gonna get slaughtered. They're gonna go down to zero because the last solution is bankruptcy. If this continues and rates continue to go higher and their debt continues to go higher, the company is gonna blow up. And this is inevitable at this point. And lastly, what about JP Morgan? What's going on here? Well, the poor stock market performance is not good for them. The revenues are gonna go down. And you have the CEO saying, hey, we have another 20% down in the stock market, so things will get worse for JP Morgan. What is the solution here? They cannot fix the stock market. They cannot just pump it higher. Maybe they can manipulate, and therefore we see all of these JP Morgan analysts, namely Marko Gokolovic, who continue to come out with notes saying, hey, you got to buy the dip. The stock market is going to move higher. This is a generational buying opportunity. No wonder why. But besides that, what is the real solution here? How about reducing expenses? What is the easiest way you can do that? Getting rid of employees. Folks, at the end of the day, all roads lead to Rome. And what is Rome here? The answer is unemployment will move higher. All of these companies will come to the same conclusion. The easiest way to deal with all of these problems is get rid of employees. And therefore, when the bulls kept saying, hey, the market, the economy is going to do fine because look at the unemployment rate, it continues to go down and we're not seeing this massive wave of layoffs. Sweetie, that's coming. It just happens to be a lagging indicator. So buckle up. And with that, folks, we have to move on to cover the stock market information for you. We start with the closing of the indices today, and here we go. The Dow Industrial Average down by 28.34 points, or a decline of 0.10%. The Nasdaq down by 9.09 points, or a decline of 0.09%. The S&P 500 down by 11.81 points, or a decline of 0.33%. The calm before the storm of the CPI. When it comes to the performance of the sectors of the market, number 1 capturing the gold medal, defensives. Number 2 for the silver, cyclicals. Number 3 for the bronze, energy. Meanwhile, the laggards of the day led by utilities, big time, down over 3% in a single day, unbelievable. On to the advance to decline ratios, NYSE 39% advancing versus 59% declining. The Nasdaq 46% advancing versus 50% declining. What about commodities? We have mixed action across the board. Of course, the dollar was muted today and therefore commodities I'm not sure what to do. We're seeing some profit taking in energy commodities, for example, ahead of the CPI, and the major reaction we're anticipating from the US dollar. And therefore, we have the WTI down about 2.5%, Brent down about 2%, also down days for gasoline, RBOB, and heating oil, be it pretty much in the flat line, down a little under half a percentage point apiece, while we have noticeable declines for natural gas down about a little over 2.25%. But folks, when we talk about inflation, it's not just crude or natural gas. Perhaps more important than all of these combined is diesel. And diesel premiums are moving significantly higher, back to the highs. And this happens to be a critical input cost for the heart of this economy, which is trucking, transportation. And if these companies are paying more in input cost, they have to charge the manufacturers and the sellers of these goods being transported. And guess what? They're going to pass that increase in costs all the way down to you and me, the consumer. And I don't know if you saw this or not from the Felder report. It is a chart that suggests that perhaps we're seeing a commodities super cycle. Whatever dips and drawdowns we're going to see in commodities, the dips will be bought, and we will see elevated commodities prices for years to come. This is at least if this chart is right. We will see a super cycle in commodities. Back to the futures, we have softs down across the board, led by cotton, down about 4.5% for the day, followed by coffee, down about 4%. Likewise, cocoa is down a little over 1.25%. Sugar muted for the day, yet we have gains led by OJ, which added about 3.5% worth of gains today. And then we have lumber futures with gain of a little over 1.5% for the day. What about metals? The notable action is silver futures down yet another 2.5%. The last few days have been absolutely horrendous for silver, and this is because the dollar continues to move higher. What about meats? We have muted action for both live and feeder cattle futures. On the other hand, we have gains of about 1.5% for the new big tech lean hogs. When it comes to grains, we have yet another pullback in wheat worth about 2%, yet we have muted reaction for soybean oil, corn, and rough rice, yet noticeable gains for soybeans, soybean meal futures, oats, and canola. We talked about oats yesterday. We're getting the bump here. Is it going to last for too long? Not really, but for now, enjoy it while you can. Moving on to the big casino, the options market, what's going on here? The volume went higher, but it's really notable that traders are buying puts, not calls. Now, is this a contrarian indicator, meaning folks are buying puts? Things are getting perhaps excessively bearish and we will see a positive reaction by the market tomorrow. That is certainly possible, but what does it require? The answer is a really cool reading of inflation. A reading that says all of these assumptions by the market that inflation is moving higher and the Fed will have to be more aggressive, all of these expectations are wrong and the Fed will indeed pivot. Now, this will take a lot and therefore therefore we have conviction here. Traders are buying puts. They're saying, hey, the reading is going to be ugly, and down we go. In certain indices, we've already broken the June bottom. What more evidence do you need to see? Again, I say, technically speaking, the risk is to the upside. We could see a surprise, and the market is going to react to the upside aggressively because we're going to have a lot of short covering. But the fundamentals say that the traders are right here in buying puts excessively. In any case, the hottest table by far in today's casino was Tesla. At around 1.7 million contracts traded today, about 54% of those were puts. At number 2, Apple, with around 1 million contracts, about 60% of those were puts. Unbelievable. I don't think I've seen this in a long time, where 60% of the volume in options for Apple traded as puts. This is conviction, folks. And then at number 3, we have Amazon at around 600,000 contracts. About 57% of those were calls. On to the unusual activities that took place in the options market today. We start with the ticker XLU for utilities. It has been crashing and somebody's betting for more pain to come. They bought the 55 puts for the expiration date, November 18th, with expectations that the XLU could lose more than 10.5% of its value by then. They paid around 65 cents apiece to enter this trade, all in all spending around $650,000. What about BAC for Bank of America? It's going to report earnings, I believe, next week, and somebody's betting that we will see a positive reaction, and they bought the 32 calls for the expiration date, November 25th, with expectations that BAC could gain more than 7% by then. They paid around $1 apiece to enter this trade, all in all spending around $600,000. And then what about the energy ETF, XLE? Somebody sees more gains to come, and they bought the 85 calls for the expiration date, October 28th, with expectations the XLE could add more than 6% worth of gains by then. They paid around $1.20 apiece to enter this trade, all in all spending around $600,000. And then what about the XLV, the healthcare ETF? Somebody's looking for safety here, and they bought the XLV, the 130 calls for the expiration date, November 18th, with expectations that the XLV could gain more than 6.5% by then. They paid around $1 apiece to enter this trade, all in all spending around $500,000. Continuing with unusual trades, what about the ticker MDGL? This is for a company called Madrigal Pharma. Now, this is an insider trade. I mean, it couldn't be more obvious than this. Somebody bought the 65 puts for the expiration date, November 18th, with expectations that MDGL could lose more than 6% of its value by then. They paid around $20 apiece to enter this trade, all in all spending around $9 million. And then what about the ticker CYTK? Once again, a candidate for an insider trade. This is for a company called Cytokinetics. Somebody sees an upside for the stock, and they bought the 55 calls for the expiration date, December 16th, with expectations that the name could move higher and gain more than 14.5% by then. They paid around $5 apiece to enter this trade, all in all spending around $2 million. And lastly, at the bottom of the table, what about the ticker MSFT, Microsoft? Somebody's betting for a rebound here. I don't see it, but to each his own. And somebody bought the 255 calls for the expiration date, November 25th, with expectations that MSFT could pop higher and gain more than 13% by then. And they paid around $2.65 apiece to enter this trade, all in all spending around $800,000. On to the heat map. What's going on here? Mixed picture, but the majority of the pain is in REITs and utilities. And this is absolutely alarming. Every single time, before the crash, before the last leg of the bear market, we see weakness in utilities. And now that rates are moving higher, there's no incentive in owning utilities at all. So this is the last defensive sector of the market, and it is cracking. We also got steep losses for the defense contractors, Lockheed Martin, Northrop, all down big. Perhaps on peace optimism, we've heard in the recent days the president talking about an apocalypse. Things are getting out of hand. This Ukraine game is getting out of hand. And now we have voices in the government, in the Pentagon, saying, hey, this has gone far enough. We gotta seek a peaceful solution here. And the defense companies don't like that, of course. Yet we did see positive reactions in today's market. and this is happening in consumer defensives, the consumer staples, mainly PepsiCo. Why PepsiCo? Well, because they reported earnings, and so far so good. They're shrinking packages, they're increasing prices, and they're not seeing consumers moving away. Even in a recession, they're going to continue to buy snacks, they will continue to buy soda cans. That's not going to change. And since we're talking about the notable movers, what about Moderna? Today we heard that mRNA will collaborate with Merck on a cancer treatment, and therefore mRNA shot up higher by almost 10% for the day. And then we got news for Comico. Now, this is a uranium stock that we trade once in a while, but today the stock was down big, and the reason is they bought a piece of Westinghouse Electric for about $8 billion. Now, this is not the time for M&A at all. The market is going to react negatively to any M&A news. We saw the negative reaction from Adobe spending $20 billion to buy another company. Here we have spending $8 billion. You can wait for now. As a company, you can wait. All of these valuations will go down, and you can buy and acquire all of these companies for pennies on the dollar once the crash happens. But now the market says you're overpaying, and hence the negative reaction that we got from Adobe, and now the negative reaction that we got from Comico. And then we have news for SLB Schlumberger, a name that I currently own. I don't know how long I'm going to keep the stock, but we have some good news here. We got an IPO over in Saudi Arabia for a company called Arabian Drilling, which happens to be partially owned by SLB. And the IPO was hot, raising about $43 billion in orders. And then we have Peloton, and this is really an interesting story by the Wall Street Journal. Apparently, disgraced co-founder / CEO / chairman of Peloton, well, he no longer holds any of these positions, but we now know why he was in a dumping spree last year. Dumping shares. Why? Apparently the guy was getting margin calls. He hedged his equity shares for whatever loans and debt he wanted to take, and as the stock started to go down, margin calls started to hit. And folks, this problem is not limited for Peloton. This has been the culture of Wall Street under quantitative easing. You got all of these CEOs and executives taking an insane amount of debt against the ownership of the equity of whatever company they're working for. As these stocks continue to crash with interest rates moving higher, we will see this story being replicated specifically in these new IPOs, profitless companies, and you might hear, oh, CEO of company, whatever, got margin called and now he has to dump shares. What do you know, the stocks of these companies go down. This is the risk right now of owning and investing in these trash companies. The odds are stacked against you. And then we have news for Dwack the Quack, the Trump SPAC, social media, whatever. Well, the stock popped higher today. The reason is they're okay in the Google Play Store. They're okay on Android phones. Not sure about iPhones, but this is good news for the normalization of Truth Capital or Truth Media or Truth Social, whatever it is. And folks, I would own a small portion of shares in Dwack the Quack, and the reason is it seems inevitable that Trump is going to run again. And once he does, in the beginning, they're going to ignore him and do a blackout. We're not going to cover his tweets because we don't want to give the guy free publicity. But at some point, they're going to cave because if he becomes, and this is the likelihood right now, if he becomes the Republican nominee in 2024, they're going to have to cover his tweets. They're going to have to cover his scandals. And this will give a lot of publicity for Dwack the Quack. And therefore, I have some shares. These are wild shot kind of trades, but you never know. The stock could shoot up higher by 20%, 50%, 100%, depending on how much attention the media is going to give to, what is it now? Truth Social. What an awful name. Anyhow, what about Wynn Resorts? The stock was down big in recent days. Number one, we have lockdowns in China. Number two, maybe this is good news actually, not bad. Well, now we know that Mr. Wynn doesn't have to register as a foreign agent because he has business with China. I mean, I don't know if the guy is even, how do I say this? I don't know if he's at full capacity because last time I met him, he was not in a good shape at all. And then what about Meta? Yesterday, we talked about Zucchiniberg. And now he says he enjoys being doubted. All of you haters. And I say, Mark, look, you got the credit. You can silence the doubters because you made Facebook. But have you ever thought that maybe you have a God complex at this point? That the wealth and the fame and the money and the power all got to your head? And now you think every idea that you have is the future, bro? Maybe you need a wake-up call here, Mark. Maybe you need to be humble. Maybe the stock of Meta being down 70% is not enough. How about we do 80%? How about 90% from the top? Maybe that'll do it. And lastly, what about Apple Incorporated, aka the iMob? Well, recently the iMob announced new perks for the store owners of Apple, but there is a catch. If you happen to be in a unionized store, you're not going to get the perks. In other words, the iMob says if you dare to unionize and you don't obey the iMob's orders and rules, we're going to cut you off. And after we cut you off, we're going to crack your kneecaps. And then we're going to crack your mother's kneecaps. And then we're going to ban you from the store. But anyhow, what about the heat map for the ETFs? Muted. The notable reaction is the XLU utilities. This is absolutely alarming. I mean, these declines are just massive, down over 3% in a single day. Yet we saw some dip buying in energy commodities ETFs such as the XOP, XLE. They were all in the green today, yet the OIH was down. All in all, muted. Nothing to see here. Waiting for the CPI. So let's do this instead. Let's move on to charts and see what's going on here. We start with SPY. 30 minutes chart for the S&P 500. Now the bulls still have some hopes because they will argue, hey, we still have the double bottom. It could be a triple bottom. It doesn't matter. But the lows are still intact for now. Who's to say that the CPI is going to come out favorable? We could see a pop higher. The bears are going to counter and say, you know what? We got a double top here. We got a rejection twice in the attempt of recapturing the June bottom. And on top of that, now we have a bear flag pattern that is already playing out. So you have the bears have two pieces of evidence, the double top and the bear flag. The bulls have barely one piece of evidence, which is maybe we're going to see a double bottom here. Who wins? The answer is the bears have the advantage. What about the daily chart for the continuous contract for the S&P 500? The volume went down slightly. The momentum indicators are waiting and waiting and waiting for the CPI. Big move is coming. Is it going to be up? Is it going to be down? For now, the chart is holding at the important support of 3,600. The fundamentals say the move should be down. The technicals say it could be either way. But now that we've seen the expectations of the market being really abysmal and ugly ahead of the CPI, the risk becomes to the upside. So you have the battle between fundamentals that say stocks should go down, yet you have the technicals say the risk is still to the upside because the surprise element is to the upside. It will take more to drive equities down at this point. What do I mean by that? If a month-over-month increase in the CPI by 0.3% would have crashed stocks a few weeks ago, now it has to be 0.5% or 0.6% month-over-month. The bar got raised higher. And the reason is the stock market is heading into the CPI battered, bruised, defeated. You know the deal. A crack below 3,600, losing that support once and for all is not going to happen in an orderly fashion. It's going to happen by a flush down, as JP Morgan suggested. What if the opposite happens? What if we see a positive reaction? Is it going to be a big one? The answer is yes. It's going to be a big one either way, but I have a feeling that if the market gaps higher in the morning in reaction to the CPI, we might see a gap and crap. We might see the chart moving all the way in an attempt to crack above 3,720.5, which happens to be the next resistance. But remember what we have on Friday. We have the Bank of England, which will start tightening once again. And therefore, I say there is a risk of a gap and crap. What about the Qs? 30 minutes chart. What's going on here? Again, the bulls are going to argue that we have what it appears to be a double bottom formation. The lows are still intact. Therefore, there is still hope. The bears are going to counter and say you couldn't make it and close above the gap. Number one. Number two, we have a bear flag consolidation. The odds are stacked against the bulls. Here is the daily chart for the continuous contract for the NASDAQ. The volume is not good. The momentum indicators are not good. The chart is below the important support, aka the June bottom at 11,058.5. Now, the week is still young. We don't have a weekly closing below the June bottom, which would be a confirmation. But looking at it right now, who has the advantage? The answer is clear. It is bears, not bulls. The bulls could start to turn the table if they close on weekly basis above the June bottom. But if the bears manage to close below the June bottom, be it after a gap and crap in the aftermath of the CPI, be it after a flush down in the aftermath of the CPI, it doesn't matter what method the bears are going to use. A weekly closing below the June bottom will seal the deal. Here's the IWM 30 minutes chart, and again, the bulls would argue, look, the chart is making higher lows. It is keeping the important support for 164.91, but the bears are going to counter and say, who cares? This is a bear flag consolidation pattern, and sooner or later, the chart loses the important support of 164.91. The Dixie daily chart, most important chart to watch tomorrow. I would say this is the bull's best evidence here because it appears that the move is stalling right now. And if it does, then we have a negative divergence on the RSI indicating weakness. And what if this happens? A reverse ABC pattern. The B leg stops at the resistance at around 113. The chart runs out of gas before making a higher high, and we see a flush down instead, forming the C leg, and we see all of these supports being lost. That is the bull's best evidence for any rally or any revival in the stock market. And here's gold, still waiting and waiting. The calm before the storm. It is holding at 1,671 right now. If the dollar goes down because the reading is tame, suggesting that perhaps the Fed is reaching the peak of interest rate hikes, then we will see the dollar going down. And in reaction, we will see an ABC pattern in gold with a rebound from 1,671 forming the C leg. Otherwise, it flushes down and it's going to go down all the way to 1,600. What about oil? A daily chart. What's going on here? This is for Brent. Again, we have a pullback. People say every time we have a pullback like this, oh look, oil is not reacting positively to the OPEC Plus decision, yada, yada, yada. Well, oil has been rallying ahead of the OPEC Plus announcement. So we have an element of sell the news here. Take profits before the CPI. But who's to say that after the CPI, we're not going to see an ABC pattern? And Brent futures might shoot up all the way to 105.43. That is entirely possible. Now, what about the 10-year yield, the daily chart? What's going on here? Yesterday, we talked about the bulls, meaning 10-year yield bulls ABC pattern, which should take the chart to higher highs. But we also talked about the bears, the 10-year yields bears, meaning equity bulls. We talked about the double top formation. It appears for now that equity bulls are winning because we have a stall before the CPI, forming the double top for now. But again, can you bet on it? Of course not. For all you know, the CPI comes out hot, we see a massive leg to the upside. But for now, for this moment, it appears that equity bulls / 10-year bears might have their way. Now, what about the TLT, a weekly chart? What's going on here? The candle is improving. Can it turn green by the end of the week? Can it shoot up higher all the way in an attempt to recapture 109.5? It's a long shot. Could it happen in 2 days? We have seen plenty of crazy things in this market, but is it likely to happen? Not really. All what we're looking for is a sign that at least we have an attempt for a bottom. And this will happen if we have a positive weekly closing in the TLT, which we haven't had in a few weeks now. On to the VIX 4 hours chart. What's going on here? It is holding 33 as support. This is the good news for the VIX bulls / equity bears. However, there's good news for equity bulls, VIX bears. That is the MACD indicator. It is showing a stall in the strength of this move in the VIX. And if we see negative impressions in the histogram from a 4 hours perspective, it will be a sign that the VIX will lose 33 as support. And if the VIX does lose 33 as support, we will see the S&P 500 rebounding once again from the so-called June bottom. What about Apple? Doesn't look good here. Apple closing the day below the support of 138.79. The momentum doesn't look good. Sooner or later, in my opinion, Apple is going to go down all the way to break its own June bottom. Tesla, an hourly chart. What's going on here? We have yet what it appears to be a fifth bear flag. And so far, these bear flags have been playing out. And if it does play out this time around, we go down to 206.86. And this is the assumption for now. And lastly, tulips, Bitcoin. What's going on here? Any update? Of course not. It is within the zone of consolidation. There is nothing we can do here. Either the buyers are going to step in and get us above 20,000 firmly, and then we're going to buy, or we're going to see the sellers showing up, cracking the chart below 18,000, and that would be a sign to go short all the way to at least 15,000. And folks, let's wrap up here. When we look at the daily chart, be it the SPY, the Qs, the IWM, they remain in the bears camp. There's nothing here for the bulls to hope for. However, when we look at the 10-year and the Dixie, we have some signs for weakness here. Number one, the possibility of a double top in the 10-year. Number two, the possibility of a reverse ABC pattern in the Dixie. And therefore, we're moving these two away from the bear camp and closer to the bull camp. When it comes to gold, that remains in the bear's camp. Nothing to see here. When it comes to the VIX, the 4 hours chart, it gets a little closer to the bull's camp because we have an imminent crossing in the MACD indicator, which will produce red impressions in the histogram. This means we have bearish momentum in the VIX. A bearish momentum in the VIX is not going to happen without a pop in the SPY. It's not a done deal here, but it's something the bulls can hold on to. Tesla remains in the bear's camp, and Bitcoin remains neutral for now. No conclusion at all. Let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We talked about the CPI, the Consumer Price Index, aka the CPI, but on top of that, we have the initial jobless claims for the week. But folks, I'm exhausted here. We have a long day ahead of us tomorrow, and it has been a long day for me today, so I have to wrap it up here and say this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.